Hi there. So we're going to talk about the differences between FHA loans and conventional loans. Think of it this way. I like to use analogies. So think of it this way. FHAs, you could say, are Ford, and conventional loans are General Motors. You know, they both do the same thing. They both are a mortgage to get you a home, okay? Are there different styles and different models and different features and benefits? Of course, but they're both great loans. And it really depends on what's important to you in the loan as to which one of those two, are you going to choose. I will say this, generally, a conventional loan is for somebody with better job stability, better credit history, and better down payment than the minimum. FHA loans are better for people with minimums in any of those areas, down payment, credit score, or credit history. So let's get into it for just a minute. The mortgage insurance is the biggest difference between FHA loans and conventional loans. FHA loans charge you double the mortgage insurance because the risk is greater on those loans. So FHA loans charge you an upfront percentage that's added onto the loan amount. So let's say you're going to buy a $100,000 loan, about $1,700 is added onto the loan to pay the upfront mortgage insurance. Then you also have to pay a monthly mortgage insurance, which depending on your down payment is somewhere between 60 to 70 bucks a month for every $100,000 that you're borrowing. It varies just a little bit, but I'm just trying to give you some ideas. So FHA loans do not reward somebody that has really high credit scores. They basically grade everybody the same on the interest rate and on the upfront mortgage insurance and on the monthly mortgage insurance. Conventional loans grade every 20 points, starting at a 640 and going all the way up to a 740. Everything above a 740 credit score is considered A+ credit. As you go down from there in 20-point increments, you get down to a 640 or in some cases a 620. The interest rate goes up, and so does the monthly cost of the mortgage insurance. The one good thing about conventional loans is they do not charge an upfront mortgage insurance. They only charge monthly. The other biggest, this is the biggest, if I've said it once, I've said it now 4 times. The biggest point about FHA versus conventional is on an FHA loan, the monthly mortgage insurance is on there for the entire life of the loan. The conventional loans, it automatically will be eliminated once you've paid the loan down to 20% of the original purchase price. Conventional loans also allow one other way to eliminate the mortgage insurance is that if your property value goes up and you've paid the loan down to create that 20% extra value, which is called equity, then you're able to request the mortgage insurance company to release it. They may or they may not, depending on how you've paid and what they think about the value of the house, but there's that option of getting out of it even earlier than having to pay it all the way down to 20% equity yourself. That's conventional loans. FHA loans is on there for the life of the loan. The only way to get rid of it is to pay the whole loan off or refinance it to a conventional loan or something else, or sell the house, of course. So that's the biggest difference is mortgage insurance. Also, on an FHA loan, you don't really get a lot better interest rate or better monthly mortgage insurance by paying more down. You could have really great credit scores, put a bunch down, and you're going to pay about the same for the interest rate and the monthly mortgage insurance as a guy that's just barely squeaking in. On a conventional loan, the higher your credit, the bigger your down payment, the lower the interest rate, and the lower the monthly mortgage insurance. So that's why I said earlier, it's really better for somebody that's a little bit more established to get a conventional loan, but somebody just coming out into the market that's done well with keeping their credit scores up and having good down payment money, 5 to 3% is considered good, can also get a really good conventional loan. And then, like I said a minute ago, credit scores really matter on conventional loans especially. So watch your credit, manage your credit, know what your credit scores are, and be sure that we're talking about what's important to you about the loan to make sure we get the right one for you. Thank you so much.